Okay, here we are in week 3 already of Finance 1031. For those of you in the face-to-face class, week 3 agenda looks like this. For those of you online, we don't really do the attendance, so not to worry. Onward. Okay, this little group actually is a series I call Quick Thoughts. Long-term assets get used up or expensed all the time. Every minute, every day they're in the business, they get used up, whether or not we actually physically use them. We just happen to add the expense up at the end of the accounting period, month, quarter, day, year, whatever the case you may be using. The expensing of a long-term asset, of course, is the depreciation expense or the amortization expense, or in the case of the Revenue Canada, capital cost allowance. And don't forget that long-term assets are also called capital assets. So if we think about capital assets, we kind of get the idea from capital cost allowance that we're talking about the cost of the original long-term asset. Kind of links it up there. Capital assets, capital cost allowance. So just remember that the amortization depreciation is an expense of the long-term assets. Okay, I often get asked about the difference between the income statement and the balance sheet, which is kind of easy. The income statement, that's all about figuring out the net profit. The net profit, of course, is at the bottom of the income statement, and the sales or revenue is at the top of the income statement. There are only two things that actually bleed over or wind up or show up or have an effect on the balance sheet from the income statement. Okay, one is the depreciation amortization expense. That actually becomes the accumulated depreciation amortization expense, expense that you see on the balance sheet. The other thing that goes over to the balance sheet from the income statement is the net profit. Okay, now we don't actually see net profit listed on the income or on the balance sheet. It goes into retained earnings. Okay, we add that into the retained earnings. So if we have profits, it gets added in to the retained earnings, which causes them to rise. If we have dividends, i.e. we give money back to the shareholders, then the retained earnings go down. And as well, if the net profit is negative, i.e. it's a loss, okay, so if we have a loss, then the earnings drop as well, okay, the retained earnings. So those two things go from the income statement to the balance sheet, the depreciation or amortization expense and the net loss or profit, and we go from there. One more quick thought. Our depreciation amortization expense gets accumulated on the balance sheet, okay? Every year it's expensed on the income statement, but every year it gets added to or accumulated on the balance sheet. Okay, that does a couple things. First of all, it shows us the book value of the asset, because the original price we paid for it minus the accumulated amortization depreciation expense tells us what the book value is. Okay, depreciation amortization on the balance sheet is listed underneath the capital assets that's being depreciated. This is done because it's a non-cash expense. Okay, we don't actually write a check called amortization or depreciation to anybody or anything. It's an allocation or a plug. It's an accountant piece of work. Okay, so this is something that we do calculations on. We move the numbers or the value, the expense gets accumulated on the balance sheet, and that way the balance sheet balances. The net income or the net profit is a summary. It summarizes all the things that happened on the income statement, and most of those are going to be involving cash flow of some sort, and that's why we can put it directly into retained earnings. Okay, but because amortization expense is not a cash event, then we have to kind of make a little fudge for it over on the left-hand side of the balance sheet called accumulated amortization depreciation. Okay, now we're going to do some more ratios, but so far we've done current ratio, quick ratio, gross margin percentage, net margin percentage, and of course the big note here is that format counts. If you give me a net margin, for instance, of 35, highly unlikely, that's a bit high, but you never know, that's wrong. Okay, a net margin percentage is what we're looking at. So that will be 35%. Same with gross margin. Just give me a number. No, it's a percent. And this is very important when we're having a conversation with people. The idea is to be able to communicate effectively. And that's why I'm a bit of a stickler for some of these formats of our ratios. It is a lot easier to have a conversation with both parties know the words.